All right, good evening, ladies and gentlemen. I'm Brian here, the organizer of tonight's event and the director of the Hayek program here at the LSE. Before we carry on, let me just introduce a bit more about our program. Our program aims to explore various topics that are related in some way to the intellectual contributions of economist F.A. Hayek. These include topics such as individualism and economic freedom, the nature and future of liberal democracy, social justice and welfare, decision-making under uncertainty, macroeconomics, which is what we're talking about tonight, the rule of law, justice, and others. Before we proceed further, I want to share with everyone our Eventbrite page, which is shown on the screen here, where you can find future upcoming events. You may simply put it into Google search and you will be directed to it. We have one event next week at the same time on Thursday evening, which is on evaluating green industrial policy, which I highly recommend you check out. On tonight's event, we have 45 minutes of presentation by our speaker, followed by a Q&A of approximately 45 minutes. We'll be ending at 8:15 p.m. Do note that this event is recorded and will be uploaded on YouTube. So during the Q&A, we will ask you to go up to the microphones on the two aisles to speak your question into the mic. If you have a mobility issue, I will personally come to you. You can just raise your hand. Do note also that the sales of tonight's book is happening just outside the booth. So at the end of today's event, you may purchase the book outside, and our speaker will remain here at the panel if you wish to get an autograph and a signature from him. So I will now introduce our speakers. We are very pleased to have with us today Dr. Tyler Goodspeed, who is the Chief Economist of Exxon Mobil Corporation. He previously chaired the White House Council of Economic Advisors from 2020 to 2021. He's the author of 4 books on economic history. He holds a PhD in economics from Cambridge University and a PhD in history from Harvard University, as well as a BA in economics and history from Harvard, an MA in history from Harvard, and MPhil in economic history from Cambridge. He has held faculty appointments at Oxford University, King's College London, and Stanford University, and is currently a senior fellow at the Adam Smith Institute. We are also joined by Professor Ricardo Reyes, who is a professor of economics here at the LSE. He will moderate and chair the Q&A session. Without further ado, let us welcome our speaker, Dr. Tyler Goodspeed.
Thank you, Brian. I should disclaim up front that the views I express this evening are indeed my own and shouldn't be interpreted as representing the views of any other entity with which I'm currently or previously have been affiliated. It's a real honor to be back at the LSE, and in particular to be with the Hayek Society. As a young scholar, I found Hayek's 1945, The Use of Knowledge in Society, to be quite formative. And as an undergraduate, I spent a summer using the archives here at LSE to view the papers of Lionel Robbins, who of course recruited Hayek to come to the LSE. So being here is always an opportunity to appreciate again the intellectual history of the institution. Prosperity breeds a crisis. Thus wrote Wesley Clare Mitchell, founding father of American business cycle research and longtime research director of the National Bureau of Economic Research, the official arbiter of US recessions. In the belief that economic expansions are cyclically culpable for their own recessionary demise, Mitchell was certainly not alone. Scores of eminent business cycle theorists have postulated that variation in the height, speed, duration, and composition of economic expansions can explain variation in the depth, speed, duration, or composition of the subsequent recession. As early as 1662, the eminent physician turned economist, Sir William Petty, suggested that cycles of dearths and plenties revolved in a period of about 7 years. 200 years later, another physician turned economist, Clément Juglar, explicitly likened economic fluctuations to disease, noting that crises, itself a medical term, crises were events that unfolded over a period of 5 to 10 years. Indeed, Juglar spoke of economic fluctuations in distinctly medical terms, using words like maladie and remedy to describe cycles of expansion and contraction. Others, including the Nobel laureate Simon Kuznets, would posit alternative periodicities to cycles of economic expansion and contraction. 3.5 years, 15 to 25 years, even long cycles of 60 years. Now, while most later economists have recognized that recessions may not be periodic phenomena, recurring at regular intervals, the notion of a business cycle has persisted. Almost all of the great interwar theorists, including Hayek, postulated that as an economic expansion continued, excess or otherwise malinvestments would tend to accumulate, rendering the economic expansion more vulnerable under the weight of its own imbalances and fragilities. More recently, in 1978, the MIT economist Charles Kindleberger published a classic tome, Manias, Panics, and Crashes, currently in its 8th edition, in which he similarly catalogs historic cycles of excessive market excitement, euphoria, succeeded by inevitable, even necessary retrenchment. More recently, scholars have developed more sophisticated models of the endogenous or otherwise self-generating business cycle. And just a year ago, Nobel laureate Joe Stiglitz wrote a very favorable overview of just that class of model. Even scholars who use and indeed pioneered the workhorse models for analyzing exogenous shocks nonetheless slip into the language of boom and bust and have built newer models with financial accelerators and asset bubbles that can generate cyclical boom-bust type behavior. So there's an august provenance to the view of cyclical booms and busts. But is it the case that to explain economic recessions, it is to the contours of the economic expansions that precede them to which we must turn? Do expansions sow the seeds of their own recessionary demise? Now, the challenge to answering this question or interrogating boom-bust or manias, panics, and crashes views of economic fluctuations is twofold. First, it's appealing. We are pattern-seeking mammals. Patterns are how we process and make sense of incoming stimuli, particularly painful stimuli. And at the end of the day, there have been many more records than there have been recessions. So stock price records, home price records, building height records. So it's not hard to find some peak, some perceived excess that subsequently declined and relate it causally to approximate recession. And that pattern matches patterns we've observed in other contexts, that what goes up must come down, and the higher it goes, the harder and faster it hits the ground. In the book, I distinguish between epiphanies and apophanies. So an epiphany is when you identify a genuine pattern in observed data, whereas an apophany, technical term, I didn't know before working on this project, but an apophany is when you identify a false pattern or assign a pattern to data that is fundamentally random. The second challenge is more technical. So a lot of key macroeconomic time series data really only became available at quarterly or monthly frequency after 1945. And since then, there have only been 12 US recessions. And actually, in the United Kingdom, only 5 recessions. Now, one might think that armed with hundreds or thousands of monthly observations of data, you have all these observations, and therefore you have lots of statistical degrees of freedom. But you really only have 12 data points, or 5 in the United Kingdom. For the statistically minded among you, that's not that many degrees of freedom. So in this project, I go back 4 centuries, assembling, harmonizing, linking many different macroeconomic time series and recession chronologies all the way back to 1700 in both the United States and the United Kingdom. So 132 recessions in total. Fortunately, the manias, panics, crashes, or boom-bust view of economic fluctuations is in at least one sense scientific, because it generates testable, falsifiable hypotheses. One hypothesis is that the longer an economic expansion has been underway, the more imbalances and fragilities and misallocations have accumulated, and therefore the higher the probability that it dies in recession. Intuitively, that which cannot go on forever will not go on forever, like an unsustainable or otherwise irrational boom. But there are also some more sophisticated models for why this might be the case. A recent paper I saw postulated a forest fire theory of economic recessions, that basically during expansions, firms are just trying to produce to meet current demand, so they hire lower productivity workers, they engage in less efficient matching, and so as the expansion continues, you have all these low efficient matches that, no pun intended, that essentially constitute dry tinder. So when you do have a shock, there's all that dry tinder that can subsequently result in a deeper recession and even makes the recession more likely. Implicit in this theory is that, like sound forest management, perhaps economies need the occasional controlled burn. But do economic expansions die of old age? Here I plot the probability that an economic expansion ends in the next quarter as a function of its age. And you'll notice that the UK line is a lot longer than the US line, because the longest UK expansion ever endured for more than twice as long as the longest US expansion on record. We'll come back to that. Now, for both these countries, for both these lines, statistically, the slopes of those lines are 0. There is no effect of expansion age on the probability that it ends in the next quarter. Now, earlier scholars in the 1990s had found that, yes, it seems to be the case that post-war US expansions didn't die of old age, but that wasn't the case for pre-war US expansions. And they attributed that finding to an increased role of the state since the 1930s and an increased role for automatic fiscal stabilizers. But here is the estimated probability that a UK expansion dies in the next quarter as a function of its age, going all the way back to 1854. Still, the slope of that line is 0. There is no effect of expansion age on the probability of death. Now, the picture seems to be a little bit different in the United States in that pre-war US expansions did seem to be more likely to die of old age the longer they've been living. But scholars have identified that the pre-war estimates of US recession dates massively overestimate the amount of time that the US was actually in recession. So there's some statistical measurement issues there. So when I substitute an improved chronology developed by Christina Romer for just half of the 90 years from 1854 to 1940, it more than halves the estimated effect of expansion age on the probability of death. So really, that's just statistical artifacts. And indeed, we see as much if we extend it back even farther on an annual basis to 1700. The slopes of those lines are technically zero. They seem to slope down. Turns out that's actually because in the 18th and early 19th centuries, expansion age, the longer an expansion had been going on, was positively correlated with peace. And peace was highly negatively correlated and peace was very highly negatively correlated with recession death, or with death and recession. In the book, I describe this as a contest between Peter Pan and Dorian Gray. So, you know the picture of Dorian Gray. The subject only superficially appears to remain exquisitely youthful, while the picture, locked away in an attic, bears all the blemishes and imperfections of each hedonistic excess deed, to the point that it can only be restored to its exquisite youth and beauty by the instrument, the very instrument of one of those hedonistic excesses. Peter Pan, on the other hand, he never grows old, but he can die. I mean, if he loses a battle with Captain Hook, he will die. So in the contest between whether economic expansions are Dorian Gray or Peter Pan, I suggest they're avowedly Peter Pan. Now, a second hypothesis is that economic recessions should be, and panics and crashes should be fairly constant across time and space. Because unless we think that people are more or less rational over time, and unless we think that human rationality varies systematically across borders, then we should expect recessions to occur with a similar frequency in the United States and the United Kingdom, and to occur with a similar frequency over time. But recessions have actually become much less frequent over time. In the 18th century, the UK had a nearly 1 in 3 chance of entering recession in any given year. By the 19th century, that declined to a 1 in 5 chance. By the 20th century, to a 1 in 10 chance. And thus far, in the 21st century, in any given year, the probability that the UK economy enters recession is just 8%, touch wood. Are we really that much less prone to mania and panic than our forebears? And the UK, as I mentioned, has long been less recession prone than the United States. In fact, over the past 2 centuries, the US has been over 50% more likely to enter recession in any given year. And since 1945, it's been twice as likely to enter recession in any given year. In fact, most recently, the US experienced recession in 2001. UK economy powered through that with growth over 1% and adding 20,000 jobs per month. Are Brits really that much less manic than Americans? Don't answer that. I describe it in the book as the patriotic recession. We tend to think of recessions as fundamentally, inherently globalist. They attend Davos. But the reality is that historically, a lot of recessions were highly patriotic. They would stop at the border. Third, if recessions were about booms and busts, manias, panics, and crashes, then we would expect to observe that higher, faster, and longer economic expansions would be followed by deeper, faster, and longer recessions. So here, I plot the peak to trough depth of an economic recession against the trough to peak height of the preceding economic expansion, as measured by GDP, consumption, investment, and bank lending. Now, under the boom-bust hypothesis, we should expect a very strong negative relationship here. Higher trough-to-peak expansions followed by deeper, lower peak-to-trough contractions. But statistically, for all these variables, for all these lines, for both countries, the effect is zero. Those slopes are flat. There is no effect of expansion height on the depth of the subsequent recession. And the same, by the way, is true for expansion speed. If you measure the speed of the economic expansion against the depth of the speed of the subsequent recession, there's no relationship. And this is the picture for the effect of expansion duration, how long an expansion has been going on subsequent recession depth. Answer, there is none. For the United States, the age of an expansion has no effect on the depth of the subsequent contraction in GDP, consumption, investment, or bank lending, and the same is true for the United Kingdom for GDP, investment, and bank lending. While larger declines in UK consumption do appear at first to follow bigger increases in UK consumption, that apparent result is driven by three unique outliers: 2020, 1919, and 1944. Now, what was going on in those years? 2020 was a pandemic recession during which Brits could not consume many of the goods and services that they would previously consume. 1919 was a very severe post-war recession during which the UK extended and even expanded wartime rationing, and the same for 1944. So, yes, those three recessions happen to involve steep declines in consumption, but they just happen to follow rather old expansions, and that fact was pure chance. Fourth, if recessions are performing some cleansing or reallocative function, then we should expect economies to look fundamentally different at the end of a recession or subsequent recovery from how they would have looked had they continued uninterrupted along long-run trend. They don't. Here, I've estimated the deviation of each GDP component's share of total output at the end of each recession against its deviation from trend share at the end of the preceding expansion. If recessions were performing a corrective, reallocative function, then we should either expect positive deviations from trend at peak to be succeeded by negative deviations or no deviations at all. Basically, the recession is correcting those deviations from trend. Instead, as you can see here, deviations at peak, trough, and subsequent peak are quantitatively very small and cluster randomly around zero. And the same pattern holds for the United Kingdom, using gross value added by industry. And actually, you can extend this back on a broader sectoral scale for the United Kingdom to 1700, and the same pattern holds. And the same pattern also holds for US employment. There's just remarkable fidelity to trend in US employment data by sector. In fact, the largest divergences were for leisure and hospitality during the 2020 recession and for government employment during the 2020 recession. So leisure and hospitality employment as a share of total employment plunged during the 2020 pandemic recession, not surprisingly, because we were not consuming a lot of leisure and hospitality services. And at the same time, as a share of total employment, government services surged above trend because government was not laying off workers the same way that other businesses were. So in composition and allocation, economies exhibit remarkable fidelity to trend. And there's just no relationship whatsoever between deviations from trend at the end of an economic expansion and deviations from trend at the end of the subsequent recession or subsequent recovery. And that holds for both the United States and United Kingdom. In the book, I describe this as a refutation of the notion postulated by former US Treasury Secretary Andrew Mellon during the Great Depression that recessions are necessary to purge the rottenness out of the system. There's no evidence for that. Now, that said, there is compelling empirical evidence that Schubertian creative destruction is essential for long-run growth. The movement of people and capital from lower productivity enterprises to higher productivity enterprises is essential for long-run growth. The question is whether that process of creative destruction is enhanced or impaired by recessions. And the evidence is overwhelming that on net, recessions impair that process. Fifth, if recessions are fundamentally about boom and bust, or irrational manias, panics, and crashes, then we should expect to observe that the increase in the size of the state and the increased use of automatic fiscal stabilizers has attenuated the depth and duration of economic recessions. But recession duration has been remarkably constant across time. And statistically, the passage of time has no effect whatsoever on average recession duration. In fact, one also cannot reject the null hypothesis of no trend breaks toward shorter recessions if you look back over the past 350 years. Now, interestingly, with the improved recession chronology, I find that both the US and UK have the pattern that recessions have always died of old age. That's in the post-war period, the pre-war period. US and UK recessions die of old age, and ultimately most US and UK recessions are over in about a year or less, and the vast majority are over in 2 years or less. And the glaring exceptions of economic recessions that endured for 3 or more years are, with one exception, correlated with war, and we'll come back to that. Interestingly, expansions have been living longer. But it turns out that that is a long-term structural trend toward longer-lived economic expansions. In fact, statistically, there have been no specific trend breaks toward longer economic expansion. So it's not in 1945, it's not in 1933, it's not in 1913. This is a long-run structural trend. There is one potential break toward longer expansions in the US, and it was 1785, right after the American Revolution. And that break point marked the conclusion of 85 years of quite a lot of colonial war and Revolutionary War that constituted a depression on par with or greater than the US Great Depression. Nor have peak to trough declines in GDP, consumption, investment, or increases in the unemployment rate been attenuated over time. Indeed, with the exception of UK consumption and investment, I cannot reject the null hypothesis that average peak to trough declines in these variables have been constant over time, going back, in some cases, all the way to 1700. And with UK consumption and investment, the magnitude of these peak to trough declines has, if anything, gotten slightly bigger over time, although that's mostly driven by an outlier of a severe 1943 to 1947 recession during World War II. Now, the volatility of these variables within each sequence of expansion and contraction has indeed declined since 1945. But they've only declined to levels of volatility observed during the 19th century. So over the breadth of the past 4 centuries, the real volatility outlier was not the period since 1945. The real volatility outlier was an incredibly martial period from 1914, the start of World War I, to 1945, the end of World War II. 6. More broadly than just height and speed, in the boom-bust view of economic fluctuations, there should be some information in economic expansions that render recessions predictable on the basis of observed information. Now, a common tool used by recession watchers is, of course, the yield curve. Ordinarily, investors expect that yields on longer-term bonds will exceed yields on shorter duration securities of the same default risk as compensation for the risks associated with holding securities over time. And this generates a positive slope to plots of yields as a function of maturity. If, however, investors expect either that the average of future short-term rates will be lower than today, or else that future inflation will be substantially lower than current inflation, then it is possible that yields on longer maturity securities will be lower than those on shorter maturity securities. And that's an event that we call a yield curve inversion. Between 1954 and 2025, recession followed inversions of the US yield curve within 2 years of the inversion event on 9 occasions. So 9 of 12 recessions, the yield curve correctly predicted, with just 3 false positives, 2 of them in the 1960s, 1 of them in 2022. Not bad. But the record doesn't look so good when one considers that 2 of the correct predictions were the 2020 pandemic recession and the 2001, it's called the dot-com recession. I call it the 9/11 recession. We can get into that. I don't think that investors in summer 2000 or summer 2019 were correctly looking ahead and anticipating a novel coronavirus or an unanticipated terrorist attack on September 11th. Moreover, if one looks at the UK, one finds that UK history is strewn with false positives and at least one false negative for the yield curve. And even within the United States, if you look back farther in time, yield curve inversions become something of a banality. Now, another popular recession forecasting tool, but is really more of an indicator, is the SOM rule, which postulates that when the 3-month moving average of the unemployment rate moves half a percentage point above its trailing 12-month average, then a recession has started. And this has a remarkable track record for the United States, correctly predicting every recession since 1948 with 1 false positive in 2024. But once again, the UK is a foil. So UK economic history is strewn with false positives and a few false negatives for the SOM indicator, including most recently 2023, 2011, 2006, 1985. And included at least 3 false negatives, including most recently during the 2008-2009 recession. So the UK economy actually didn't breach the SOM threshold until September 2008, when the UK economy was already 5 months into a recession. And various attempts to use composite indices of leading indicators have similarly yielded a disappointing track record for forecasting and predicting in recessions. Now, dynamic factor models with Markov switching do a remarkable job matching the official US recession chronology, but this isn't so much forecasting recessions so much as mapping them ex post, because when you consider the lags with which the data that is inputted into these models requires, it's not really a real-time indicator. Moreover, most of these models are trained on 7 or 8 post-war US recessions, which again, is that an exercise in estimation, or is that an exercise in curve fitting? The reality is that recessions are fundamentally unforecastable. Because if you could know that there was going to be a recession tomorrow, you would spend less today, businesses would invest less today, hire less today, and you would get a recession today rather than tomorrow. So ironically, as interwar business cycle theorists were expending a lot of intellectual energy trying to develop models of the self-generating business cycle, of the fundamental inherent instability of capitalist market systems, it was actually a Soviet economist in 1927 in Moscow, Eugen Slutsky, who took old Russian lottery tickets, and he constructed moving averages, moving sums of the numbers in those lottery tickets. And he then mapped that moving sum onto an index of 19th century British business cycle conditions. And as you can see, it maps almost beautifully onto the economic fluctuations. And what it demonstrated was that the summation of chance causes can generate what appears to be cyclical fluctuations, even though the genuine data generating process is random. So I liken it to rolling each year many-sided die. So for example, you might have a pandemic die. We had a pandemic in 1918, we had a pandemic in 2020, so maybe that's a 100-sided die. And if you roll that and it comes up a 1, you get a pandemic. And you can multiply that across all sorts of other different shocks. Bottom line, there is nothing in the height, the speed, the duration, or composition of an economic expansion that can explain variation in the depth, speed, duration, composition of the subsequent recession. So what does cause recessions? And what ends them? Well, unlike a pure academic seminar, there is a positive price on this insight, so I can't give away too much. But I can say that fundamentally, recessions are about shocks. As we've seen, economic expansions do not die of infirmity or advanced age. In the words of former Federal Reserve Chairman Ben Bernanke, they get murdered. And when you look across the past 4 centuries of economic history, one does spot several serial killers of or serial accomplices to the murder of economic expansions. War and energy shocks are 2 of them. And indeed, they're 2 of the most prolific assassins of economic expansions on both sides of the Atlantic. In fact, since 1945, oil supply shocks have been major contributing factors to all but 2, 1960 and 2020, of the 12 US recessions, and to all but 1, 2020, of the 5 UK recessions. Before the rise of oil, industrial action in the coal industry was a frequent contributor to the demise of economic expansions on both sides of the Atlantic, from the late 19th century right up until 1970. And in the 18th century, and as late as the 1870s, severe winter weather and spring flooding occasionally created what were referred to at the time as turf famines. Turf, or peat, was an essential fuel because the combustion of it was used for residential heating and industrial power generation. Indeed, harvest failures in the 18th and 19th centuries were effectively adverse energy supply shocks, considering that commercial transportation relied overwhelmingly on animal draft power, for which biomass, provender, was the fuel. I've already highlighted the frequent contribution of war. If you look at the most protracted economic recessions, those lasting 3 or more years, all but one, the Great Depression, were associated with major armed conflict. So in the United Kingdom, 1947, that was tied for longest recession in UK history. It was tied with the recession at the end of the 7 Years' War, which was referred to as the First World War, or Global War. There was another major 3-year recession in the UK that ended in 1921, associated with the dislocations of World War I. In the United States, you had a depression-level recession during the American Revolution. You had a severe recession during the Articles of Confederation period, during which you had the continuation of armed conflict with indigenous Americans. You had the mass exodus of tens of thousands of loyalists. You had an armed uprising in Shays' Rebellion, and you had financial chaos under the loose Articles of Confederation with a lot of uncertainty about the status of wartime debts. And then you have this odd 1720. Now, the farther back in time you go, the harder it is to identify recessions because the data is just less available. But you do have reliable trade data, you do have reliable monetary data, and some other series. And when I'm looking at the data for the early 18th century, there is a depression-level event that's happening from 1717 to 1720. And when you then go and look at the qualitative evidence, what were people writing about at the time? The answer is a surprising source: pirates. So this was the peak, the climax of the so-called golden age of Atlantic piracy. So you'd had the War of Spanish Succession, during which the British government had paid people to become privateers. After the end of the war, you have all these unemployed privateers. They turn to piracy. And you look at contemporary accounts, and you have the major port of Charleston in South Carolina that was blockaded by Edward Teach, whom some of you may know better as Blackbeard. All of the infamous brigands of Atlantic piracy, Benjamin Hornigold, the cross-dressing Anne Bonny and Mary Read, Calico Jack Rackham, all of these were active, and you see a complete collapse in colonial trade. And you read accounts of commercial vessels being intercepted from Salem to Boston off the coast of Long Island. You have raiders going up the Chesapeake Bay. You have commerce raiding as far north as Newfoundland, and a complete collapse in colonial trade that really only begins to recover once the Royal Navy captures some of these infamous brigands, or they accept the King's pardon. In the case of those captured, the Royal Navy typically displayed the corpses pour encourager les autres. But by 1721, you start to see this recovery in trade. And 1932, therefore, is the outlier of extremely protracted recessions. This was, of course, the Great Depression in the United States. Now, we often associate it with the stock market crash of 1929, but really, the Great Depression was a succession of shocks of really substantial magnitude. So you had 4 distinct banking crises, 3 of which were distinctly regional in nature, one of which was related to a 2-year drought, a once-in-a-generation drought of such severity that in 1931 it resulted in a plague of locusts of providential proportions. And you look at the pattern of bank failures in 1931, and it is concentrated entirely on the span of American prairie where the 8th plague of Egypt descended. You also had a tariff shock. You had a business taxation shock in that they removed a previous exemption from business taxation for small and medium-sized enterprises, earning the 2024 equivalent of less than $500,000. So think of the hundreds of thousands of businesses that were suddenly affected by this tax. So you have all of this going on in a succession of shocks. And that is the one exception, the unique outlier to these protracted 3- and 4-year recessions. In more recent decades, a perennial contributor to economic recessions in the United States was credit controls and policy mistakes more generally. So the imposition of consumer credit control, so basically restrictions on the amount of credit that banks could provide to consumers and the terms under which they could extend those loans, were contributors to a relatively mild US recession in 1948, again in 1970, again in 1980. And those were bipartisan. So Truman did it, Carter did it, and in 1970, Nixon didn't quite do it, but in classic Nixon fashion, he jawboned the banks to voluntarily restrict credit, and Congress gave the president authorization to impose them if he wanted. Therefore, banks tended to voluntarily restrict credit, lest they be imposed involuntarily. So I view this as a reminder that policymakers should first and foremost adhere to some form of the Hippocratic Oath. First, do no harm. Sometimes recessions are simply the consequence of sector-specific shocks. affecting a small subset of sectors that unfortunately have very high linkages to the rest of the economy, and the output from which other sectors and households have a very limited ability to find substitutes over any near-term time horizon. And as I said, most recessions are over within about a year or less. Certainly, energy and bank credit are prime examples, but others historically included cotton. In 1862, there was a deep recession in the United Kingdom. It was widely known as the cotton famine as a result of the Union blockade of Confederate cotton exports. Automobiles were another. Indeed, the relatively mild 1927 US recession was largely the consequence of the months-long shutdown of Ford Motor Company's factories as they retooled to switch from the Model T to the Model A. And you think about the upstream and downstream linkages of an industry as large and vital as automobiles. The irony here is that though booms do not precede busts, booms do follow busts. Deeper, faster recessions are followed by higher, faster rebounds. So while we tend to look at economic expansions as the deviance, as the excessive deviations from trend growth, to which recessions are the painful yet necessary correction, it is in fact the other way around. Recessions are negative deviations from trend growth, to which economic expansions constitute the remedial deviation correction. And a classic example of this would be the 1920s. We think about the excesses of the 1920s, the Roaring '20s, and by the way, no one called it them the Roaring '20s during the 1920s. They were only called the Roaring '20s after the subsequent contraction. Yes, there was a big increase in building activity and investment during the 1920s, but the question is, what was the stock? There was an increase in the flow of investment, but that was really only getting the total volume of, the cumulative volume of investment and capital stock closer to where it would have been had you not had 6 years of World War, a pandemic, a wave of strikes after the war as a result of wartime inflation. So the question is, which is the deviation from trend? And what I demonstrate in the book is that the deviation was 1914 to 1921. The 1920s were correcting for that negative deviation in the run-up to 1929. The good news is that we have, over time, been getting better at absorbing the kinds of shocks that historically would have killed economic expansions. Expansions are living longer, and recessions are less frequent than in prior decades and centuries. And I think that note of optimism is a reminder to us that we worry a lot about recessions because recessions hurt a lot of people. But we ought to be at least as concerned about economic expansions because ultimately the economy's trend growth rate matters much more for long-run economic prosperity and human flourishing. The United Kingdom has been much less recession-prone than the United States. The United Kingdom is also about 30% poorer per person than the United States. So we ought, therefore, to be at least as concerned about the majority of years in which economies expand as we are about the minority of years in which they contract. Though it may be odd for a book about recessions to so conclude, so it does. Thank you.
Very good. So thank you so much. That was extremely clear and quite insightful, both merging some developments in economics over the last couple of decades, and I think recessions, but also giving them some of your own original insights. I want to ask 3 sets of questions. So I'll do 1, 2, 3 rounds, you know, and then I'll open it to the audience when it comes to the topic of your book, Tyler. So I'm going to start. Let me start with just the sense in which the book is applicable outside of the US and the UK. The book, rightly so, focuses very much on data from the US and somewhat so also, I think, on data from the UK. But as an economist, scientist, let me even say that word, we'd like to learn things that are generalizable in a more general sense to other economic countries. And certainly here at the LSE, we're very much about thinking about different countries. And I'm sure in the audience, there's people from many different places. So I pose 3 challenges to you in sense of how the focus on the US and UK to some extent may shape some of your results and conclusions. And that is because the US, I'll say the US, but that's true of the UK, is a large country, a stable country, and a close country in the 200 plus years that you looked at it. What do I mean by large? Up until the beginning of the 20th century, we had agricultural economies. The US, though, being so large, has a relatively diversified agricultural basis. And so the cycles that come in agriculture, of which many crops are, and which inspired actually the first business cycle theorists of the early 20th century, cancel out across different crops in the US in a way they don't in other countries, whether that is Ireland, Spain, to speak about a couple where there's been quite a bit of studies of their business cycles. And when we look at the business cycles in Spain or Ireland, to pick 2 examples, but other relatively smallish economies, you do see much more of that predictability that you don't find associated with the natural agricultural cycle of some crops. You'll have 3 or 4 good years, and then a year of fallow, 3 or 4 good years, and you're fallow, and there's a certain predictability to it that comes from that lack of diversification. So in that sense, the fact that you pointed that we don't see that predictability of the cycles looking at cyclical functions may be a function of either modern economies, non-agricultural economies, or of the US as a whole in that sense. And likewise, the US for 200-ish years, as you know very well for our audience, has really grown at a very steady rate for these 200 years. But when one looks at, and I'd like to get your reactions to a country like, let me pick now on China, for a country that has a very low growth rate that becomes a very high growth rate, measuring business cycles in itself, including the way you went about it with peaks and troughs, becomes challenging because what happens when the growth rate accelerates? Do we say that China is not at a recession in 40 or 50 years because it has grown at a very high rate? Or do we still look within these last 50 years at when did it grow a little faster, a little slower, to try to identify peaks and troughs? That is, how do we deal with trends? A problem that you didn't have to deal with too much because in the US it's not a big issue, but it is there. That is, if I made you on the spot, give me a cycle analysis of China in the last 50 years, would you say there hasn't been a single recession? There have been many. I think that will clarify the extent to which we think of those. And then third, the US is a relatively closed economy. So when you look at shocks, the glaring omission, let's say, and I'm being unfair and call it glaring here, is that there were no external shocks. You told the story of shocks, and most of them were internal in some ways. But if you look at small open economies, if you look at, say, most economies in the EU right now, most of the shocks come from elsewhere because you're a small open economy, and something happens in Germany determines whether there's a recession in Portugal. So given that, can you tell me a little bit, expand a little bit, I'm going to give you a chance to expand of using your concepts, your ideas to agricultural economies, to economies that go through growth spurts, as well as economies that are much more dependent on external shocks. Could I ask you on the spot to write me a second edition of the book that has an international component or a few chapters?
Sure. So first of all, the reasons I focused on the US and UK were threefold. One, they have some of the highest quality data going back a long ways in time. Two, they happen to be the geographies and economic histories that I know the best. Oh, there we go. They happen to be the economic histories with which I have the most expertise. And also because they are two of the most similar economies. I mean, those two economies are very similar and probably most similar to each other than they are to any other economies. And yet they have very different recessionary experiences. In terms of the role of harvest shocks, I think that is a question of frequency rather than cyclicality. Because when one does look at the chronology for recessions in the 18th century, yes, you see a preponderance of harvest shocks contributing to the death of economic expansions. Sometimes it skips a year, sometimes it's 4 years, and there's not a clear pattern to it. It's rolling the dice. When it comes to China, this is an economy that I do touch on in the book, in part because when I was pitching the book to potential publishers, one of them asked, well, why doesn't China have recessions? And I kind of scratched my head because China had just had a recession. Arguably, it was what we might call a double dip recession in 2020 and 2021. China also had a devastating recession in the 1960s during the Great Leap Forward, a similarly devastating recession during the Cultural Revolution, and probably, if one looks at the statistics, had a recession in 1989. And when one considers the political activity that occurred in 1989 in China, perhaps we should not be surprised. When it comes to the closed economy, yes, I think that's related to the patriotism or globalism of different recessions. And the US as a large, diversified, large open economy, call it, maybe mostly closed in prior periods, that it makes sense that a lot of shocks would generate recessions that were patriotic in nature, as indeed we saw one before the Great Depression, one of the most severe recessions in the United States. In the old chronology, it was also one of the longest, but that probably overstates its duration, but was a recession from 1873 to 1875, maybe a little bit longer. And that was another visitation on the US economy of the eighth plague of Egypt.
Very good. So I'll summarize. If I can summarize your answer, you're saying it's still agricultural shocks, even agricultural economy, as opposed to cycles. That you are, in the econ lingo, thinks there's are growth cycles. You should look beyond the trend, not on levels. And third, that yes, the shocks may be external. If you're a smaller economy, they'll be more patriotic for a large economy. Is that a proper summary?
Good summary.
Very good.
And China has had their fair share of recessions. Yep.
Exactly. If you do a growth cycles again, if you take out deviation from trend. Second set of questions on the shocks. So modern economic theory has embraced this way of thinking of business cycles as shocks. And it's a great work that you in your book has essentially brought that also to economic history and going back and validated that and had a lot of flavor to it. But modern economic theorists, at least, faced the following challenge, which was very well captured when the Queen visited us here at the LIC, I forget, 15 or 16 years ago, and opened the building at the Economist Park where my office is. And we were in the midst of the great financial crisis, and the Queen said, "How did you not see it coming?" To which my colleagues, I was not a member here, said, "It's not my job to see it coming. It's a shock. I can't predict it coming. My job is to explain the mechanisms, the propagation, what to do to stop it, not to cause your own shocks, by the way, but a shock like a financial crisis is just not my job because shocks are by definition unpredictable." It didn't go too well. I don't think the Queen quite accepted it at the time, or Royal Highness, and still others still have trouble with that. Would you, with your view of shocks, again, would you embrace this meekish way in which economists reply to why didn't you see it coming because shocks are unpredictable, or would you not? Second, and related, when you say shocks, and we talk, and this is again a deep debate, but which I think you can share your honest view, shocks may be symmetric or asymmetric. And so we can think of shocks as being just negative bumps along the road that cause recessions, or statisticians don't think of shocks that way. They think of shocks as negative and positive. And you would see that, well, there's also bumps up that cause booms above the way or not. Your account, being very focused on recessions, as the title indicates, was all on the negative shocks. Is it because you would subscribe even to the Milton Friedman view that there's only negative shocks, the so-called plucking theory of the business cycles? We tread along and then we get negative shocks, or would it be more like the real business cycle theory that there's negative and positive shocks and we oscillate around that trend? Would be a question on that. And then thirdly, on the depth and management of the shocks, as you well put it, And as you know, Christine and David Romer have worked a lot on the extent to which policy-induced shocks, or as they would put it, the Fed caused almost every recession. I think those are their provocative papers that they wrote once, by just tightening rates and creating a policy shock. But the debate around the Great Moderation, as you in part know, post-1980s, we just had a lower volatility, it seemed, the business cycle. Apparent, because then we've had some pretty big shocks. But one of the discussions around there was the extent to which the shocks were the same, but we can manage them better. Starting in the 1980s, especially Japanese techniques on just-in-time inventory allowed firms to manage shocks to demand better. Perhaps better monetary policy, again, that would be the Romer view, allowed us to prevent some shocks from happening. And maybe, and why not look about the present, maybe AI will allow us to, as consumers and firms, better forecast fluctuations in a way that allows us to offset the shocks. To what extent, in your shock view, do you think that it is, and this continues a little bit in the previous question, shocks may be inevitable, but the way we manage them, or even don't cause our own shocks, is part of what we as economists, or certainly policymakers as economists, should be doing. So unpredictability, symmetry, and to what extent is there room for the management of the shocks? If you can deepen a little bit the shock view on that, both with you.
Sure. So on the oscillations, positive and negative shocks, I think visually, if all you do is look at a graph of actual GDP and estimates of potential, it's a strong endorsement of plucking theory, that economies are capable of growing roughly at potential, not much above it. If you do try to push too far above it, you might end up with that translated into price rather than quantity. And then you have these adverse shocks that come along and you deviate from potential, but then eventually recover back to it. In terms of the Queen's question, yes, economists, most economists today and in 2009 would say, well, they're about shocks, we can't predict shocks. But they will also then look at the wrong shocks. Because think about, and even just how we talk about economic recessions, we'll look at asset price bubbles. I used to talk about the dot-com recession. I used to talk about the housing recession. So we look for these big asset price declines. We still have the mentality of looking for some excess, some error, something was wrong, and then there's a decline, and that is the impulse. And then you can have other propagation mechanisms, but that is the impulse. But just take two of the recent shocks to which we say, oh, well, we couldn't predict it, although there's sort of an implicit, like if you look at the cyclically adjusted price to earnings ratio, in 2001, you would say, of course you're gonna have a recession. And you have a lot of people say, well, look at housing prices in the 2000s. But then actually ask what happened in 2001? What happened in 2008? So 2001, you had at least 4 shocks that were impacting the US economy, not the UK economy, but the US economy, of which I demonstrate in the book, the decline in tech stocks was quantitatively the least important. If you take estimates of the marginal propensity to consume out of financial wealth and apply it to the magnitude of the decline in the NASDAQ, it is incapable of explaining the decline in consumption in 2001. Especially when you consider that a lot of tech stocks were not owned by Americans, they were owned by foreign investors, and ownership skewed toward higher net worth individuals who tend to be less responsive to changes in financial wealth. In addition, or more important than that, you had an energy shock in 2000-2001. As Asia recovered very quickly from the Asian financial crisis, you had a big increase in particularly natural gas prices in the United States. Didn't affect Britain because you have big price differentials in gas because of the physical infrastructure associated with it. So we had an energy crisis in 2000-2001. These were the summers, some of you maybe recall, of rolling blackouts in the largest economy in the United States, namely California. And actually it was those rolling blackouts that contributed to the demise of Enron. A third shock was the establishment in October 2000 of permanent normal trade relations with the People's Republic of China. That's most favored nation status with a multi-trillion-dollar non-market economy. And the immediate impact of that was a collapse in net hiring in goods-producing industries in the United States. There was also a modest increase in layoffs, but fundamentally it was about a drop in hiring. And that actually characterizes most recessions, is that in the first instance, they are about a decline in the rate at which firms hire workers rather than an increase in the rate at which they fire workers. And then the fourth shock, and I argue is the most important, was 9/11. All of the output decline in 2001 in the United States was in the quarter that included the terrorist attacks, which was an enormous human and physical capital destruction. It resulted in the complete closure of U.S. airspace and widespread fear and justified concern that resulted in a contraction in consumer spending. So those were the shock. It should be called the 9/11 recession. And in 2008, if I asked you, when did the price of a barrel of oil or a gallon of gasoline reach its all-time high to date? Was it 73? Was it 79? Was it 1990? No, it was June 2008. This was the worst energy price shock of the post-war period, a combination of coincident shocks to supply and demand that resulted in the average American having to pay over $2,000 more per year on energy goods and services at the same time that their mortgage was resetting higher and they had to spend $800 more per year. So was that a mortgage shock or was that an energy shock? And remember, the bottom half of the US income distribution has no savings after tax. So something had to give. And rather than spend less on commuting to work, dropping your kids off, heating and cooling your home, a small minority of Americans were late on their mortgage. And then lower vol over the Great Moderation. Instructive is the differential recessionary experience between the United States and the United Kingdom. So why did the United Kingdom historically have fewer recessions than the United States? There are two reasons. One, there are two reasons the United Kingdom has historically had fewer recessions than the United States. One, they had, from 1826 on, a national system of nationwide branch banking. So banks could branch across the entire country. It's like a broadly diversified portfolio. And when some banks got into trouble, they could be absorbed by other banks, and losses in one region or sector could be balanced by gains and resilience in others. In the United States, in contrast, for most of US history, not only could you not operate a bank across state lines, you couldn't even operate more than one bank within a state. So you had tens of thousands of tiny, undercapitalized, underdiversified financial institutions that would amplify adverse shocks. When did that change? From the 1970s, 1980s on, when we removed those restrictions on unit banking. The second reason for greater UK stability was that from 1945 through 1973, the US experienced oil-induced or in part oil-induced recessions in 1948, 1953, 1957, 1970. Those oil shocks did not impact the UK economy much. Why? Because the UK economy overwhelmingly relied on coal that happened to be relatively abundant and domestically sourced. And let's face it, oil and coal are not perfect substitutes over the near term. You can't run a diesel electric train or a heavy fuel oil tanker or a commercial aviation on coal. So the UK was relatively immune from that. And since the 1970s, with the exception of a recession in 1990, a recession in 2001, and a recession in 2008, those were all energy-related recessions. So I think banking and energy were two of the main drivers of why we did have a period of moderation.
Very good. Last one from me, and then I'll open it to the audience. When one thinks about business cycles as shocks, often the challenge is that, and you've partly addressed it, but it's something we need to dig a little deeper on, is that shocks are very often in particular sectors. When we think about shocks, energy will affect some sectors more than some others and so on. So then you start thinking of business cycles, or the challenge of business cycles, so much so that you can go down that rabbit and forget the rest, as why is it that we observe such co-movement? A business cycle is characterized by the fact that all the industries go up and all the industries go down together, that employment and production go down together. Co-movement even sometimes, going back to my small open economy that I can't resist being on this side of the Atlantic, all these different regions of the European Union go back together. But that's also true in the US. We certainly observe some differences, but there's a lot of this co-movement and so on. And this, at least superficially, puts a challenge to the shock account, because it's, well, most shocks are going to be region-specific and others, and so they will cancel out. And so, yes, sometimes you'll have a shock that affects everyone, but those will be the rare instances or not. And yet, recessions are a distinguishing feature of all of them, is that it's really all the sectors move together. How would you reconcile this? I mean, is it just about the input-output networks? Maybe that's the answer you're going to give me. Is it about just the special kinds of shocks that have the potential to propagate? But the co-movement across variables, regions, and whatnot. Tell me how you see those in the context of a shock-based economy recession.
Well, and it's that was one of the signature findings of Burns and Mitchell in measuring business cycles, was a defining feature is the co-movement across multiple sectors. And that is why, yes, as you said, sometimes you get these events like war, like pandemics, that affect huge swaths of the economy all at once. More typical does seem to be the sector-specific shocks to sectors whose output have very high linkages, are inputs into production in the entire rest of the economy, or much of the rest of the economy, and over a near-term time horizon, firms and households just have very limited ability to find substitutes. And that's why energy is a perennial, bank credit is a perennial, and cotton historically was a contributor. There was a boll weevil infection that contributed to that also Ford-induced recession in 1927, and then multiple cotton recessions in the 19th century, in part because when your cash crop goes down, your exports of your cash crop go down, it means your net exports go down, and therefore you have gold outflows. And that would create tightening credit conditions. So it does tend to be some of these sector-specific shocks that can generate co-movement because of those elasticities of substitution and high linkages.
Very good. So I'm going to open to the floor. Please just put your hand up, or no, put your hand up actually. Just please walk to those microphones as you wish to line. I'll take one or two questions at a time, and then we'll go and discuss them. I guess I should have warned you to start lining up before, but if you want to ask a question, please approach one of the microphones, and we'll have a little bit of time to go for it. So someone has to be bold, so I'll start with the gentleman over there.
Hello, thank you. Really interesting.
Oh, I should have said that. My apologies. Before you ask your question, just say your name and your affiliation or relation to LSE, especially for the video. It's very helpful. Thank you.
Oh, yeah, sorry. Daniel Freeman from the Institute of Economic Affairs. Excellent talk and an excellent book. Do you think there is any sort of... you point out that the UK has, on average, fewer recessions over the last century than the US, and yet the UK is significantly poorer than the US, and then especially since 2007, we have been growing at a much lower rate than the US. Is it possible that there are sort of the same causes are leading to both of these things, that maybe regulatory, structural, or cultural conservatism in the UK is contributing both to us avoiding lots of recessions, but also us overall growing more slowly and being more poor?
Great question. And indeed, the UK economy post-2008, 2009 was one of the exceptions to the broader pattern of typically deeper recessions are followed by deeper rebounds, higher, faster rebounds. And your question highlights a conclusion of the book, which is that we ought to be careful not to over-medicate or otherwise sedate economic expansions that ultimately die not only innocent but healthy. And in the case of the UK, post-2008, 2009, we, and by we I mean
financial regulators on both sides of the Atlantic, I mean, this was a shock shared, determined that economies needed to produce with less of a critical input into production for which there is limited ability to substitute, particularly in the United Kingdom, namely bank credit. So on the eve of the crisis, 60 to 80% of British businesses' external financing came from banks. In the US, it was 20 to 40%. And after 2008, 2009, on both sides of the Atlantic, we said, banks, you need to substitute lending to the public sector for lending to the private sector. Now, don't then therefore be surprised when businesses cannot produce as much with less of a critical input, namely bank credit. And the US wasn't as impacted by this because we had private equity, much more private equity, venture capital, angel investors. We still had thousands of regional banks that were too small to be caught up in the new regulatory regime, whereas in the United Kingdom you had fewer and on average larger financial institutions and therefore more likely to be covered by the new regulatory regime.
Thanks for the talk. It was super interesting, and I'm looking forward to reading the book. I'm James Rice. I'm a LSE alumni and affiliate of the Hayek program here. So I guess I have two broad focus areas which I'm interested to hear more from you. The first one is regarding sort of the prediction of macroeconomic cycles and the forecasting of recessions. And you sort of mentioned this caveat that, you know, obviously if we were able to perfectly forecast recessions, the recession would simply move up because people would anticipate that their dollars would be valued less in the future, and so they would try to we would actually realize the instance of the recession much sooner. And so I wonder what would be sort of the policy implications of actually being able to understand what a recession might look like in the future, what sectors of the economy it might influence, and from like the sort of a top-down perspective, like what exactly would that imply for actually creating policies which would end up ideally mitigating a recession should it occur in the future. The second question I have is regarding sort of the increased financialization of the economy, and so I wonder about this from sort of a systemic risk perspective. So it's interesting to think about the increased complexity of the financial system that's sort of created this architecture that over time is more interdependent across multiple sectors of the economy. And we've also seen the rise of very complex financial instruments, not only in the wake or in the lead up to the Great Recession, but also after the Great Recession with the increase in high frequency trading and different types of very complex financial maneuvers that rely on a great deal amount of leverage, for instance. So I wonder, in that context, why do you think we have a financial system or an economy that's more robust to shocks, where we're seeing less recessions and shorter recessions in the modern era, if we have this sort of financial system which is more systemically risky in the context of the complexity of the architecture and the perhaps, I don't know if you would argue with this, but perhaps the lack of regulation around moderating those financial variables that depend on many other factors across the economy.
Yeah, so on the predictability of sort of future recessions, I think one should exercise caution in not presuming too much knowledge, because as I noted, we've been getting better at absorbing the kinds of shocks that historically would have ended economic expansions. Harvest shocks don't have the same impact that they used to. And when you think about some of the factors that have contributed to the demise of expansions in recent decades, I think it's a fool's errand to try and predict a novel coronavirus in 2020. Or maybe if you have enough geopolitical expertise, you could have predicted that Saddam Hussein would invade Kuwait and we would get a large energy price spike in 1990. But I would say, and this actually will dovetail with your second question, I think that there are two ways in which we are particularly becoming better at absorbing these sorts of shocks. One is just thinking in terms of insurance. What is the probability of supply unavailability under certain scenarios? What is the cost that I would incur in the event of that supply unavailability? What's the dot product of those two? And then how does that compare to the premium I would have to pay, the price premium I would have to pay to maybe source that supply from elsewhere? And then secondly, I would contend, and I think the evidence of the past 3 centuries would contend, that the increased financialization of the US economy has on net been enhancing rather than detracting from resilience, because it means that households, that a shock to income or employment doesn't necessarily translate into a shock to consumption, because consumers, households, and businesses have the ability to borrow to smooth some of that spending over time. So I think on net, it has helped to enable consumption smoothing and to enable the diversification and reallocation of risk from folks who are less able to bear it to those who are better able to bear it. And indeed, part of the convergence between the US and the UK in terms of recession probability did coincide with sort of the US banking looking a bit more like British banking over time. Thank you.
Hi, I'm Merajul Islam, and I'm a student at Harris Westminster Sixth Form. And I don't really have a relation to LSE other than the fact that I want to apply here for uni. And so my question is the business cycle becoming more synchronized between advanced economies like the UK and the US due to globalization?
It's a great question, and yes, though many historical recessions were patriots, the patriotism of economic recessions, even between the US and the UK, has been declining over time. And that applies not just to the starting a recession or being in recession in any given year or quarter, but also correlations in other macroeconomic variables has been rising over time. So I think it is safe to attribute that decreased patriotism of US and UK recessions to deeper economic integration over the past century.
Thank you.
Let me do a follow-up question on that, actually, Tyler, because it is the Hayek Center. And so let's ask a very Hayekian question, which is, as we think about the propagation of cycles across countries, what is the role of floating versus fixed exchange rates? Hayek, Friedman as well, but Hayek very strongly advocated for floating exchange rates. He did it on many grounds. Friedman followed it by actually making exactly the point that floating exchange rates would lead to less propagation of shocks across borders. The evidence for that is more mixed than the arguments are. But generally speaking, how do you think of, for instance, a fixing of the exchange rate by adopting a single currency in the euro area? Is that an amplifier of business cycles in Europe or a dampener of it? How do you think of the US since the 1970s having a complete floating exchange without any intervention from the Treasury or the Fed to control it?
So, as I said, one of the interesting features of 18th and early 19th century recessions on both sides of the Atlantic was that sometimes you would get an adverse harvest shock or adverse, for example, for cotton or wheat in the United Kingdom, cotton in the United States, wheat in the United Kingdom, and that would result in a decline in net exports, either because you're exporting less cotton or you're having to import more wheat, and that would result in net external drains, and you would get tightening credit conditions. However, as I showed here this evening, if you look at the duration of recessions, if you look at the depth of recessions, they have been pretty constant over time. So I'm not sure that the currency regime, at least for those two large diversified economies, can explain much in terms of variation in terms of the impact of these shocks.
Well, go for it. Let's take one last question.
Hi, my name is Makai King. I don't really have any other way to introduce myself, but I'm an aspiring economist. My question is not too long. It's pretty much just like, you know how you were talking about how you had acquired data from the past 300 years? How did you you had extra data, like there was 2 different lines, the second one, you corrected the data. How did that come about? Like, how did you correct the previous data from before?
Great question. So my starting point for the US is the official National Bureau of Economic Research chronology, which dates US recessions going back to 1854 on a quarterly basis. However, Christina Romer has found that pre-1927, the NBER series overstates the amount of time that the US was in recession. Therefore, she developed an alternative chronology and a methodology for identifying that chronology, and going back to the 1880s. So on a quarterly basis, I substituted her alternative chronology for the official one. And then on an annual basis, going back to the 18th century, another scholar, Davis 2006, has developed an alternative recession chronology using an index of business conditions. And so that I substitute for the official NBER series. And it's very fascinating to look at how those different substitutions impact the results. Usually they don't impact the results so much, except in the case of sort of the recession probability, you know, what's the probability of recession as a function of age. But yeah, for most of the analysis, I try to use the latest, most enhanced recession chronology.
Let me actually, if you're curious, I'll add a little more if you don't mind. So Davis was actually a PhD student of Christina Romer. So actually that's where that comes from. The big difficulty when you go to the 19th century is that we don't have GDP data. GDP was invented in 1940. So what we have is a bunch of proxies. And so what Christina does, what John Davis did, and Joe Davis, sorry, not John, and Tyler uses, we just try to come up with better proxies for GDP. And when you have really bad measures of GDP, the series looks really erratic. And as you do better and better, they look smoother. You try to identify peaks and troughs, you start doing a much better job. And so it's really about how do you figure out GDP when we didn't measure it, we didn't collect it, we have no tax collections, and so you're using the harvest of this and that and combine them and smoothing them better by doing more. And it makes a really big difference for the reasons basically you were saying, because you're trying to figure out what's the max and the min as you go along. So that's the very fun economic history work. Sorry, Tyler could have explained this, but I thought I would add a little more color to it.
Would you say it's kind of like using new formulas to correct and make
and new data? So Joe Davis, for instance, was Tyler said it, is the index of business conditions. So we used to, some of the 19th century data on GDP, we had ore production. I forget, there's a couple more, you may know. We had 2 or 3, and then Davis found these other 2 index of business conditions. Now we had a few more series to build a pseudo GDP series with a few more data. You may remember
and I was just going to say, and also one of the things I do in this book is I bring the U.S. quarterly data back to 1875 on a consistent basis, and on an annual basis back to 1790, and consumption and investment back to the 1834.
But this is all work of using proxies to build new ones, and better proxies and more indicators that we unearth from libraries, because we only started measuring GDP in 1940 in terms of the actual official in real time. That's a great question for our students. Very good. Let me thank Tyler. This was, I thought, was a fascinating discussion, and I think really deep in both understanding modern understandings of business cycles, but also very insightful observations on if you embrace the shocks view, then what shocks, how to manage shocks, what are the relevant shocks or not. So let me just finish it by thanking Tyler very much for coming and joining us. Oh, and I will add that Tyler will very kindly and graciously stay here a little bit if you want to sign a book or just talk to him. There's also some books on the outside. You just can't leave without signing my own book. But as soon as he finishes signing my book, feel free to either get some books outside or just come on stage and talk to him.